Hi, accounting students. Welcome back. This is Mrs. Bloomquist, and we are talking Chapter 5. So we're looking at Lesson 2 in Chapter 5, which is bank reconciliation. Remember, in Lesson 1 in Chapter 5, we were looking at checking accounts. And a couple things that you want to make sure that you're thinking about. First of all, since we've learned how to manage a checking account, we also need to learn how to verify the bank's records against the records of our business, and know that our records need to match what the bank is reporting and vice versa. So one thing you just kind of want to be aware of is that all bank statements basically have the same information on them, but they're going to show up in a slightly different format. So you're going to want to just double check to make sure you know where everything is on your bank statement. And you're going to want to make sure that you double check everything that's on the bank statement against what's in the business records. And then particularly, you need to make sure you understand the difference between the vocabulary that is a canceled check versus an outstanding check, and what those two things mean. So definitely touch base in the book if you don't realize the difference here between an outstanding check and a canceled check. Okay, whoops, let's backtrack here. So lesson 2, we're looking at completing a bank statement reconciliation and then doing a recording and journalizing of a bank's service charge. So the first thing that we're looking at here is the bank statement, and just know that it's the record of all of the deposits and the withdrawals, the balance information, and potentially any service charges that would be showing up on our bank statement. A check that has been paid by the bank is considered to be canceled, which means it went through all of the banking system, it's canceled, and then the funds have moved. Okay, so the bank statement reconciliation, when we're looking at this, what you're seeing is that this is a reconciliation for the month of January, and we're looking at our records and comparing them with the bank's records. So the first thing here that we're looking at is that we post the date, so January 31st, and we're looking at the stub balance in our business records tied to stub 14. So all of our activities through the end of the month, then through that's check stub number 14. Looks like the bank reported a service charge that we had not previously reported on our stub balance. So we're adjusting or subtracting off that $25 in our stub so that we have good records for our business. The next thing then that we're going to do is look on our bank statement and find the balance on our bank statement. Once we report the balance on our bank statement, we're going to go through and find out, are there any deposits that are considered outstanding or any checks that are considered outstanding? So when we go ahead and compare our bank records with our business records, if there are checks that we have written but they haven't cleared our bank yet, those would be considered outstanding. Same story with a deposit. If we have a deposit in our records that we have posted in our check stubs, but that deposit has not cleared our bank account yet, or it's not showing up in our bank account, then it's considered outstanding. Looks like we have one outstanding deposit. Typically, outstanding deposits only show up on the last day of the month or the last 2 days of the month. We subtotal out, and then we go through and we list any outstanding checks. So checks we've written, but they have not appeared on our bank statement yet because they've not cleared our bank account. Once we go ahead and adjust then our bank balance, what you should see is that our check stub and our bank balance should match. And we need to make sure we reconcile our business records with our bank statement once a month. Okay, so once you compare those adjusted balances, if they match, you're good to go. All right, so now we know that have that $25 service charge that the bank charged us for something, that we need to go ahead and report that on a check stub. So it looks like check stub number 14, where we were doing that reconciliation, that's where we started from. We bring forward our balance, we subtract off the service charge, and now we have that subtotal of $25.95. We can still use this check number 14, and then you can see we would subtract that off and have a balance we could carry forward on our check stubs. Okay, so we're going to write this the service charge in and subtract it off. Now, we also need to journalize that bank service charge. We can't forget about the journaling piece of this. So on January 31st, we received our bank statement showing that service charge of $25. Now we're going to do a memo, and make sure you remember the vocabulary for what a memo is. So our miscellaneous expenses go up and our cash goes down. So when we go ahead and post this as a general journal entry, it happened on the 31st. It's a miscellaneous expense, and our document or our source document is memo number 3. We're going to debit expenses and credit cash. Okay, so you want to be able to identify 4 reasons why a depositor's records and a bank record might differ. All right, and you want to consider when you are recording bank information and comparing your bank statement records with your business records, every time you have a check that you know is issued and it's cleared your bank, you're going to go ahead and check that off in the check stub, okay, in the check stub area, and make sure then that you have that checked off. So the question that is the last question here, it says, if a check mark is placed on the stub of the canceled check, what does a check stub with no check mark mean? So you should be able to identify that that then is something that's outstanding. All right, that's it for lesson 2 for chapter 5. And you want to go ahead and answer the Audit Your Understanding questions that are out on our website in the form, and then go ahead and do the work together and on your own for chapter 5.